Okay, welcome everybody to episode 70. I do apologize. It's been about a month since we've done one of these. It seems a little odd to me. It's always, when I take a little break, it always feels a little bit strange. I'm worried about the audio, worried about the internet. And if you've been reading my emails, you know the reason we skipped is because I've moved. So it actually took me a little while to soundproof this room. You can't really see it, but there's basically sound deadening panels all over this room. And have to order them from China, so it took quite a while. So here we are. We've got a new set, new studio. I'll probably change a few things, but let me know in the comment section if this is acceptable. I don't own a lot of things. As everybody knows, I'm kind of a minimalist. Pretty much everything I own in the world, you can see most of it in this picture. I've got golf clubs, bunch of running shoes, a few watches. That's about it. Clothes. Not a whole lot of clothes, to be honest. So it's pretty tough to actually put stuff behind me that's interesting to look at. So I did my best, put on some cool, colorful running shoes, and this is the best I can do. So thank you, everybody, for joining. I think today is going to be a good one because I oftentimes try to put together something that will apply, of course, to the VTS community if you're part of it. Today is going to be directly related to that. But there is also the factor that if you do have your own strategies and your own stuff that outside of VTS, of course, no problem. Live streams are free. But I think this is going to help a lot of people out as well. So definitely want to get into it. One thing I will say really quickly is quite a few people who watch my YouTube channel, I think it's about 75%, are not subscribed. So if you could do me that favor and just subscribe to it, that would be great. And of course, give the video a like. Don't pay anything. Don't super chat. Live streams are always free. But let's get into the first topic today. I should also probably mention really quickly that I did a whole bunch of internet testing. This is a new house. Everything seems okay, but the only way I'll really know that is by doing this. So if it happens to be going in and out, not much I can do. I'll watch the rebroadcast and we'll see. This is the best I've got. This is my office now. So I'm actually streaming to 4 different places, both YouTube channels, LinkedIn, Twitter. I can probably take that back a little bit if the internet's bad, but hopefully everything's all good. So today's topic, like I said, we are essentially going to be trying to answer the question of what are the best safety asset classes. So this relates very directly to one of our strategies. So I'm going to be talking about one of our VTS strategies today called strategic tail risk. But again, if you're not in the VTS community, doesn't mean you turn it off. It just means that you're not trading that strategy, but you probably have your own. Some of this will probably ring true for you as well. So the first thing that I want to do is actually review very quickly what this strategy is that we're talking about. And this is going to make some sense for your own trading if you are a tactical investor like I am. So strategic tail risk strategy, first of all, this is one of 5 that we have. So it's the red one right here. Our portfolio is 5 independent strategies. We're going to be focusing in on this red one here today. So essentially what this strategy is, we are tactically rotating between potential positions based on current volatility levels. So I've got a volatility barometer. You've probably heard me speak about this before. It's in every email. This is my comprehensive way to measure the true market volatility. Because things like the VIX index, it's a terrible indicator. It really doesn't say much of anything. There's things like the VIX futures, like the cash VIX term structure, but anything taken as an individual metric is not going to be very robust at all. So what we do, apologies for the scrolling, but I actually designed my own volatility index that takes into account several other of the indicators that people look at. You know, the VIX futures, the VRP, difference between implied and historical volatility, M4 to M7, distant VIX futures, the cash VIX term structure, all the, VIX 9D to VIX 3M, 6M, all of that. There's several metrics included in the barometer, plus more that you don't see here. So it is a comprehensive view of volatility. And based on these levels, that's how I'm going to be deciding which asset class we're going to be holding. So the truth is that pretty much everybody out there knows what to do when the stock market is cooperating, right? When stocks are stable and basically consistent, marching higher, pretty much everybody knows you're going to be in some variation of net long the stock market, net short volatility, whether you use leverage or not, whether you use options or not to gain a little leverage. Pretty much everybody knows what to do in this situation. I would say that probably this is a little bit less people who know this, but there are some people who know that there's a great opportunity to go long volatility when the market is all out crashing. So for here, this is only on 2.72% of trading days for our strategy. This is going into the VIXM, a long volatility ETP, and this is a good opportunity to capitalize on just those most extreme crashes. Pandemic, 2020, 2018, Volpocalypse, Q4 2018, something like the financial crisis, which we launched VTS in 2012, so it was before that. But obviously, I do believe that something like that will repeat in the future. That's what these positions are for. So hopefully you've been utilizing a little bit of long volatility in your strategies. But what we're talking about today is, what do you do when you're between the rather obvious net long the market and the very sliver of opportunity to make a lot of money going net short the market, net long vol? What do you do in the middle? Right? This basically makes or breaks a strategy. As we say, it separates the men from the boys. This is what you have to nail down if you want to have long-term success. It's not enough to just hold the stock market and then ride all the drawdowns as well. We know that long-term buy and hold, there's nothing wrong with holding stocks during good times. But the reason buy and hold sucks is because there's going to be plenty of down periods as well. So we have to figure out what to do here. Now you can see it says IYR real estate, but this isn't completely accurate. The strategy as we have right now, we were using real estate for a number of years, but in the last year or so, because interest rates have been going up, we actually have exited as much of our portfolio positions as we can that are sensitive to interest rates. So you can see it actually has a cash position there. And what we're going to nail down today is when we get an indication that interest rates are going to top and then perhaps even start going down again, what are we going to replace this with? That's really going to make or break the strategies long term. You can see we do have a pure short volatility strategy. This one is using gold as the safety position. And then we've got another tactical strategy called defensive rotation. This one's using utilities. So we've got some safety positions, but this one's in cash. So what are we going to do? Now, before I dive into this, because I'm going to go through a long list of asset classes, some of them, of course, you're going to know. Hopefully, some of them are new to you, and I might give you a few ideas. You might think, oh, wow, I've never heard of that ETF before. I'll look into that one. So before I do that, though, just leave in the comment section before you cheat and look at the numbers at the very end. Everybody kind of just comment, what are your 2 or 3 favorite safety positions? Like I said, net long the market is fairly obvious about half the time. And then hopefully you're going to be waiting for that perfect opportunity to go long vol. We all know how to do that as well. What are you going to do when the market is ambiguous in that middle ground, that no man's land? Put it in the comment section. And now let's actually look at some numbers. So what I've done is I'm going to just go across the page. Hopefully everybody can see this spreadsheet. It will freeze on me from time to time. If you tuned into the live streams, you know it's coming. MacBook's going to beach ball on me. But I'm going to do the best I can. So the first thing that we're going to look at is the TLT. This is a Treasuries ETF, 20-year U.S. Treasury. And in fact, early on in this strategy's run that we had when I launched it, several years ago now, we used to use the TLT. But then we switched out many years ago and we put the IYR real estate ETF in instead. And you're going to see why we did that in a second. But TLT is not actually that terrible as long as interest rates are going down. I don't know if you are aware of that or not, what the reasoning there is, but I can just tell you really quickly. Interest rates and bond funds have an inverse correlation. Nope, that's for later on. Sorry about that, little spoiler alert. But as interest rates are going up, this is going to be an inverse correlation to bond funds like the TLT. It's a Treasury ETF. It's going to have a lot of trouble when you see something like this. The reason the TLT was so good for our strategy for so many years is because we had zero interest rates basically, and we didn't actually leave the TLT as our safety until interest rates started to rise right about there in 2017, 2018. It started to get a little bit rough. So you can see that actually in the numbers that TLT isn't so bad, right? Right up there until about 2020, it was hanging pretty close with the S&P 500. Again, I guess I should have explained this. This baseline black line is what would happen if we just kept in the S&P 500 during those safety positions. We did not cycle out into a different asset. We just hung on with stocks because here, this is the stock market. Here's where we have to cycle out of it. The baseline SPY is just showing, and I'm going to include it in all the charts so you can see it, what would happen there. And essentially, we're just trying to beat the SPY. We're just trying to do something that's going to outperform the S&P 500 for us. And there's many ways that we can do that, as you'll see. But treasuries, unfortunately, with the current interest rate environment, this is just an unusable asset class, which is strange because, most people's portfolios are still reflecting that a lot of the investment world holds bonds. So performance in the last 3 or 4 years for buy and hold diversified portfolios has been pretty dismal. Stock market, not so bad, of course, because the Magnificent Seven, the Apples, Tesla, Google, they've been doing quite well. But pretty much everything else in the investment world is terrible, including bonds. So this is a no-go right now. IEF, this is a 7 to 10-year U.S. Treasuries. No surprise here, kind of the same pattern. It was decent for a while. It was equal to the SPY. And then right when interest rates started to rise, it dropped off a cliff. You're going to see a recurring theme of that as we go here. SHV, this is an interesting one. This is a very short-term treasuries ETF, basically a cash vehicle, so to speak. It's not technically cash. It is very short-term treasuries, but you're basically just trying to get a very short-term interest rate. You can see here it did almost nothing when interest rates were flat, as we would expect. Rates are basically zero. There would be no reason to hold money market funds or anything like that. But in recent times, we've seen an uptick. Obviously, rates are getting much better, and there is actually legitimate reason. Anytime you've got cash in your portfolio, you could just dump it into something like the SHV. Just to give you an example, I also do that. The SHV is just kind of this rolling position that I kind of use. Anytime I've got additional capital in my portfolio that's not being allocated, I will just dump it into this. But as far as an actual strategy position, kind of a waste of time because it is so directly related to current interest rates that really there's probably better options, as you'll see, but not bad. Gold, always an interesting one, always a favorite of mine. Now, as I said, we do use gold already. We've got the Tactical Volatility Strategy, which is basically a pure long-short volatility strategy, and gold is just our safety dump cash there whenever we're not in either long or short. So we're already using gold. I'm going to show it anyway, as well as utilities for the defensive rotation. I'm going to show utilities as well, just to give a comprehensive look. But just remember that this isn't really available today because we're already using it in another strategy. But gold is very good. Gold is actually one of the very few asset classes that legitimately is uncorrelated to the stock market most of the time. And that's a very good benefit because when you're looking at something that is supposed to protect you when you don't want to be in stocks, you don't want to just jump into other asset classes that are basically just like stocks. You want to get into things that have a legitimate chance to do better than the stock market. And you can see that gold has done that more or less. Slightly lower return, but better drawdown. This is actually a good safety position. Perhaps not for everybody, but for the way that my portfolio is structured, this is a good profile for one of our 5 strategies to hold this as our safety. Then we've got the XLU. Like I mentioned, this is also already being used. The reason it's being used in the defensive rotation is this is arguably the best safety position on the market right now. Has been for 10 or 15 years. So I'm just scrolling through the comments here. Don't know if anybody actually said utilities, but let's check out why I say utilities has been so good. Essentially, crushes the stock market during unstable market periods, but again, you're going to see a recurring theme today. You can see that drop off in the last year or so. Well, why did that happen? Why is there a drop off? Well, as it turns out, as well as several other assets we will talk about, there is a little bit of an interest rate component to utilities. It's not direct. It's not as strong as bonds, for example. That's a very strong, basically, by definition, inverse correlation. But utilities will have an element of interest rate sensitivity to them. And that's why we have actually been seeing some significant weakness in the last year for the utilities. But we still use it in one of our strategies. I think it's awesome. I like the utilities. XLP. This is the consumer staples ETF. So if you're not aware, the S&P 500 is basically comprised of 11 sectors, and consumer staples is one of those sectors. So if you were a type of person that you wanted to maintain your positive correlation to the stock market, but you wanted to figure out which sector is actually a little bit safer than the SPY, this is probably something you could consider. You can see the profile here. It's not going to do a whole lot better than the S&P 500. It is strongly correlated, of course. It's one of the 11 sectors, but you can see that it is actually a little more stable. And that makes sense. When you think of a ambiguous market period, probably consumer staple type things, that's where people will default to their money. It's maybe a little bit safer. There's also some yield there, a little bit higher dividends for some of these things. There's reason to believe it could be a little more stable. But I would not call it safety simply because it is going to go down with the market. IYR, another very interesting one. So this is real estate, by the way. IYR real estate, and you saw this was default position. We were using real estate for a number of years. The reason, again, real estate is most of the time pretty great. You can see all the way up until the last 1 year. Interest rate component to real estate, of course, it's there. Not directly inverse, not like bonds, but pretty strong. So no surprise here, real estate has struggled a lot in the last year. But before that, excellent safety position. I will be looking, as soon as the Fed signals that basically it's time to start cutting rates again, I would basically put IYR real estate back on your radar as something you could dump cash into anytime the stock market is ambiguous. XLI, not much to see here. This is industrials. This is another one of the sectors for the S&P 500. Super highly correlated to stocks. There would be no reason really to do this. It's kind of just a point of interest. XLB, basic materials, again, another S&P sector. Same story here. Super strongly correlated. I would rather just stick to the S&P 500, to be honest. But people email me about that. They ask. So there it is. US dollar, UUP. This is something that people think, I do get a lot of private emails. Hey, have you considered this asset class? Why aren't we in this? The reason that oftentimes people say those things, right? They'll email me and say, well, I don't understand. This asset class is doing exceptionally well. Why doesn't your strategy rotate into that? You have to understand that the way that you have to design your strategies, none of us can see the future, right? There's a lot of people on Twitter that'll claim that they can, but of course they can't either. So what we have to do is basically figure out what are the asset classes that are going to best handle the majority of future unknown events. Obviously, 2020 hindsight, we can look back and we can say, oh, in the last 6 months, we should have been in the US dollar, or we should have been in oil, or whatever it is. There's always going to be those aberrations. But for me, as an investor, a tactical investor, quant-based, looking at the numbers, I have to know that not only is it doing well the last 6 months, but it would have done well for all the right reasons in the last 10 or 15 years as well. And then I would have an expectation of it going forward. The US dollar is one of those things where it can have moments where it appears like it's doing pretty well, but then basically for the long term, there would be no reason to ever use the UUP in any tactical strategy. Obviously, cash is better than this. If there's no performance and there is a drawdown, then something as simple as the SHV, very short-term treasuries, that's going to be better than this no matter what. So US dollar, I understand there can be certain periods, you can see here, rocketing higher. This is a log scale, so it might not look great. But in the moment, for about 6 months, people are like, why aren't we in this thing? It's doing great. Well, you can see why we're not in that thing. I need to look a little bit more long-term than that. Emerging markets, another super interesting one. This is one that, I do try to remain quant-based and strictly by the numbers. But emerging markets, for whatever reason, and I have used them in the past for certain strategies here and there, even though the numbers look good, you can see that the performance is better than the SPY and the drawdown is a little bit lower. Just statistically speaking, this is clearly better over the last 12 years. Anytime I've in the US or in the emerging markets, I have always had an uneasy feeling. Like I can see the numbers, I can see the math, but just conceptually, it just doesn't feel like it's a real safety position. And it always feels like things could go off the rails, to me personally. But the reason I'm showing this to everybody, and it is by the numbers a good performer, is maybe you don't feel the same way I do. Of course, everybody's mileage will vary. It's trading. We all have our preferences. For me personally, I've just never felt comfortable with emerging markets. But like I said, this is for your information as well, and you might. Commodities, DBC. This one always shocks me. For some reason, there's a lot of people out there, a lot of portfolio managers, they always recommend holding commodities, sort of buy and hold. If you want to see what happens when you kind of do that, I really don't understand why anybody would want to do that, right? Buy and hold itself is disaster. But people oftentimes, and it was similar to what I was saying before, people will allow tremendous short-term periods of performance to cloud their long-term judgment. So if you were a portfolio manager in 2020 to 2022, you can see a pretty strong case for why, everybody in the world should be holding commodity funds, right? Well, not really, right? That's just a short-term aberration. After the pandemic, there was obviously a huge run up there, but we do have to look more long-term than that. So commodities, unfortunately, it is super popular. It is very common for people to hold within their air quotes diversified buy and hold portfolios. But why? We can see the numbers. We can see how things move over time. There would be no reason, in my opinion, to be using anything like this. And I don't know why there are certain very famous asset managers that somehow think that holding a constant 10 or 15 or even 20% holdings to this is a good idea, but it is what it is. SPY is just our baseline. Berkshire Hathaway, some people might wonder, well, is Berkshire even better than the SPY? Well, actually, yes, a little bit. Drawdown basically the same, 1% better. You got to remember that this is only happening on 31% of trading days. So anytime you're seeing these numbers, some people might think, 5.3%, that's not very good. You got to remember that this is 31% of trading days on the most ambiguous times during the stock market. So clearly the SPY is doing far better than that 5, right? For us, we sometimes even use the SSO, 2 times leverage. So this is only 31% of the strategy. Probably should have made that crystal clear at the beginning, but these numbers are actually pretty good. If you can pull out 5 or 6% compound annual growth rate during the most ambiguous times in a strategy, then pretty good chance that the strategy itself is a good performer. And you can see, obviously there's some decent performance there, not coming from this section. We're just trying to do significantly better than this, the SPY. Can we cycle out into something better? Berkshire, not much to see there. This one's interesting though. Coca-Cola. So for me personally, if I was ever to hold a stock and try to somehow quasi-deem it as a safety position, I would say Coca-Cola. Now, people might wonder why. Well, it's just very consistent, especially during ambiguous market periods. There is just something about Coca-Cola, maybe the dividend, maybe the fact that it's an aristocrat. It's been around for so many decades, but it's just very consistent. Low drawdown, good performance, very consistent. You could, if you wanted, like I said, if you're the type of person that is looking to maintain your positive stock market correlation, but just do better than the market, Coca-Cola should always be quite near the top of your list. For me, it's right at the top. PBJ, you might not have heard of this before, but I like to just throw things in there. This is basically a food and beverage ETF. So similar to Coca-Cola, similar to Pepsi, but it's just PB&J. And also exceptionally good. Actually, even lower drawdown than Coca-Cola. So this one is 18 with a 6.4. This one is lower performance, but lower drawdown as well. So you could make a case that PBJ is actually a very good, positively correlated safety position. This one, SH. Let's get into SH. SH is an inverse ETF to the S&P 500. So before I show you the results, some of you are going to know what it's going to look like, but I would say of all the asset classes that people email me and they say, hey, how come we're not doing that? Inverse, basically short the stock market, is by far the most popular one. People are asking all the time, well, if we don't want to be in stocks right now and you're trying to exit out because it's maybe dangerous and ambiguous, well, surely we should be shorting the market, right? Well, no, because what ends up happening with these ambiguous periods in the market, you do want to deleverage your portfolio and you do want to move to safety, But that doesn't mean that the stock market's going down, right? You can see that most of the time, even when things are looking bad in the market, it doesn't fall off a cliff. It only maybe every couple of years is going to fall off that cliff. So if you're in the habit of shorting the market 31% of the time, this is just no man's land for your strategies. You're going to be just basically getting crumbs. I mean, obviously, pandemic would have been fantastic to be short the market. For a very brief moment in time, you would have felt like a rock star. But most of the time, if you're shorting the market, you're just going to be bleeding capital. And I would say, of course, I can't tell anyone what to do, can't give any direct investment advice. But just for me personally, shorting the market is out. It's just off the table. The only basically short market stuff that we do is during 2.72% of trading days, I'm comfortable holding long volatility. Other than that, shorting the market, just not a good idea. You can see it just doesn't go down very often. Most of the time, even when it feels like, wow, it should be a recession, it should be the end of the world, it just doesn't fall off a cliff. So be very careful if you're shorting the market. SPLV. Did I go back to screen share? Hopefully I don't make that. It's been a month since I've done one of these live streams. All right, we're good to go. SPLV, this is the S&P 500 Low Volatility Fund. So what this thing does is it essentially holds 100 of the lowest volatility stocks in the S&P 500 over the last 12 months. So it is a technical, basically a mandate. It scans the 507 or 506 S&P 500 companies, and it picks the 100 over the trailing 12 months that had the lowest volatility. And interestingly enough, it is actually a little bit better than the SPY. If you wanted to reduce drawdowns, there it is. This is another thing similar to the Coca-Cola thing that I was talking about. If you don't want to jump out into gold, if you don't want to jump out into utilities because you're scared that you might miss out on something, keeping that positive stock market correlation but reducing your drawdown, this would actually be a good way to do it. And there's one that I think is even slightly better. It's called SPHD. And what this one does is it takes the 50 lowest volatility funds over the last 12 months in the S&P 500, the lowest 50, but they also have to be the highest yielding dividends. So this is called the S&P HD, standing for high dividend. And this one kind of the same thing. Good performance, low drawdown. This is also much better than the stock market. To be able to pull out 6% in the what I would deem the worst 31% of trading days, pretty solid here. You can't go too far wrong here. Again, I prefer real estate, prefer utilities, prefer gold, but not so bad here. SPHD. Another one, BTOL. Okay. This is going to be a test for everybody. So BTOL, I'm going to explain what it is, and then you're going to post in the comments how you think it should perform based on the description of the ETF that I give you, and then I'll show you the results. So what BTOL does is it's basically a long-short fund where it's going long the lowest volatility stocks in the S&P 500, and it's going short the highest volatility stocks in the S&P 500. So you see how that works, right? Somebody had the brilliant / stupid idea to hold long the low vol stuff, the low beta stuff, and to short all those high beta stocks, right? So you can see how this is going. So based on that description, how does everybody think something like the BTOL would perform long term, right? If you're holding long all the low vol, you're shorting all the high vol, presumably the person that's putting this together, the managers in charge of this, they're under the impression that the high beta stocks are bad, right? Those are the ones that are violently crashing all the time. That's why they're high beta, right? So you want to short those ones. Is that what high beta tells us, though? I mean, I'm sort of leading the question here, but you got to remember this is actually somewhat similar to the S&P 5 or the VIX index as well. Let me close a bunch of these things. Why do I have so many of them open? The VIX index is also a volatility index, right? And people always think, and incorrectly they think, that there is always an inverse relationship between the S&P 500 and the VIX index, right? The VIX goes up, SPY's going down. If the SPY goes up, the VIX is going to go down, right? It's just an inverse of the S&P. That's not actually true. The VIX index is directionless. It does not say anything about the positive or negative direction of the stock market. It's just volatility, just variance around a mean, essentially. So there are times when the stock market is raging higher and the VIX can also go up with it. And not only can it do that, but it actually has. We have historical periods that exactly that happened. So you can see this is the annual VIX index mean since 1990. Look at this, 1997 to 2000. This is a time when the stock market is raging higher. Of course, this is the lead up to the dot-com bust. So stocks are going up 20, 30%. Well, look at the VIX. It's averaging in the mid-20s, low to mid-20s. Why is that? Well, like I said, volatility is directionless. Volatility is just variance around a mean. It's just based on how much it's moving. It could be up movement. So when you look at something like the BTOL, like I explained, if you're going to be going, what do I want to pull up here? If you're going to be going long all the low beta names and short all the high beta names, some of those high beta names that you're shorting are actually going to be high beta for the wrong reason. They're going to be high beta because they're performing so well that they're so high beta. So this is actually the BTOL performance. It's not as good as you would think. So then when you punch it into our little formulas here, you can see it's not great. It's not completely terrible. You can see it had one miserable period, and the last 3 or 4 years, not so good. But you just have to remember that anytime these, I call them dynamic funds, these dynamic funds managed by a team get this idea that, okay, we're going to avoid these high beta stocks. We're going to go towards the low beta. We're going to avoid the high beta. It's not always a good idea because it's a terrible filter. It's not direction. It's not strength of performance. It is just a measure that could very well be for all the wrong reasons, right? Some of the best stocks you would want to hold, they actually do have high beta. So just be aware of that something like that, it might sound good on paper, but don't expect it to do so well. And then we've got several other dynamic funds, and none of these have been around since 2012. Everything you've seen so far launched the same day I launched VTS. But there's a whole bunch of dynamic funds that have launched in the last several years. I'm going to do another live stream and see how many drawdowns we can cover. Can certainly get the pandemic for most of them, maybe even back to 2018. But MSVX, I've actually made a video on my YouTube channel about that one. It's not great, but it's up there. The video's there. I explain why it's not such a good fund. PHDG, some of these you might have heard of, XYLD. And then you've got things like the Tail, interesting one. I'll go into that. The Simplify, there's a suite of products from Simplify, SPD. There's one called SPYC. I'm going to go through several of these. These names, you might have heard of some of these. But we're going to actually put those through the testing as well in a future stream. And we'll see if some of those have potential. I personally, as I always said, I like to be my own risk manager. I don't like to hold ETFs that are dynamically managed by a team because I don't really know their mandates. I don't exactly know if it's going to work out in the future. Some of these things, they sound great on paper, but they never really pan out in trading. So I like to do it myself. Like you've seen, I have all my strategies and my levels, and I'm moving in and out of positions. Not often, don't mean to scare you away. We trade about roughly 2 to 3 times per month per strategy. But the point is that dynamic funds do exist, and we're going to break down those. We're going to see if any of them have any future potential. But now what we're going to look at, everything we just looked at, I've broken it all down into a summary here. So what we've got, again, this is 31% of trading days. So we're not expecting these numbers to be that great. This is the 31% essentially most ambiguous times in the stock market. And I've arranged them from best performance to worst performance, that old inverse S&P 500. I can't tell you not to hold it, but, wink, wink, don't hold it. It's terrible. And then I've also got the drawdowns here, and then just the ratio, the return divided by the drawdown to get a risk-reward, simple risk-reward ratio. This is marked in orange. Utilities is the best one, 8.95%. pretty fantastic during 31% of trading days, but we already use it within our defensive rotation strategy. That is our go-to safety position here. And aside from, like I said, some interest rate sensitivity down here in about 2020, 2021, of course, this strategy has done exceptionally well. I suppose I always think of our direct short volatility strategy as the flagship at VTS, but you could certainly make a case that since defensive rotation has made 30% a year since I launched, you could make a case that it's a flagship strategy. This is already being used. Gold, as I mentioned, it's in green because it's also being used. But it's great. I have no problem with this at all. Pretty good ratio simply because the drawdown is significantly lower than the stock market. But now we have to actually choose some of these. So you can kind of get an idea for what your tastes are. I would say number one, for me personally, and I don't know if you've noticed this is just a little side tangent, but if you're a member of VTS, everything to do with defensive rotation is always orange. Everything to do with tactical volatility is green. And everything to do with strategic tail risk is red. What a surprise. I color-coded my strategies. It's just for me on my end to keep everything organized. For me personally, every time I see charts that are in yellow, I know it's iron condor related. When I see purple, I know this is our UVXY butterfly strategy. So color-coded, look at that. How original. But this one, I'm going to actually mark red because this is one of my favorites. Again, only because of interest rate sensitivity and only because the last 2 years interest rates have been skyrocketing. This one used to be the best safety position. So we're still going to label that. The next one, if I was to choose, of course, emerging markets is good technically. So we can give that a little red. We can highlight that one. Remember, I said the SPHD, the low vol, high dividend yield ETF, this is a pretty good one. The only problem here is that it does have positive stock market correlation. So it's not going to be as good as real estate. You're not going to get those periods where stocks are going down and real estate can actually still go up. Utilities can still go up. Gold can still go up. This one will not. Anytime you're doing that or you're doing Coca-Cola, for example, which is also a great performer with low drawdown, these two, you are going to take a hit when stocks go down. It's just you can expect it to be minimized a little bit. That would be the point there. So how about some of these others? Really, nothing else really stands out. Again, BTOL, terrible. Treasuries were good for a time, but personally, for me, real estate is better anyway. So probably the days of me using bond funds are pretty much finished. But these are the top ones. So you can see the black is the baseline SPY. All of them significantly outperform the SPY. So you could take your pick. And I'm saying this to members and non-members. Members of VTS, I send out the signals. There is nothing saying that you can't make a replacement. If you see something that you think, well, I think that's actually better, and maybe I send out a signal that says IYR, you can see up until the last 1 year, real estate was the best one. But perhaps you're just like, no, I like Coke. I like Coca-Cola. Or, like I explained, I don't feel comfortable in emerging markets. Maybe you love emerging markets. And every time I say, we're going to buy IYR, you can say, nope, simple replacement. I'm going to go with the emerging markets. You can see all of them are better. It's just based on how you feel the forward market is going to be over the next several months. You can kind of pick your favorite. But hopefully people learned a little bit. Hopefully I mentioned a few there that you haven't heard of before. PB&J, probably not on too many people's radar, but a surprisingly good safety position. And yeah, I would say I'm patiently waiting for that signal for those interest rates to at least, this is it, we're finally done, and then potentially going down again. Once we get that signal, the investing world will start to make more sense. The last year and a half, 2 years, everything's been upended because the only thing that's been working is stocks during good times. That's it. Because volatility hasn't spiked high enough to make any money on the long vol side. It's just basically been kind of muted volatility. You could argue that, short-term options, zero DTE options and all that stuff, okay, granted, but doesn't change the fact that we're not getting those extreme high volatility readings. So inverse the market in any capacity has not been working the last couple of years. And all the safety positions, bonds have been much worse than the stock market, and real estate, utilities, all the classic safety positions the last year and a half, everything failed. So it's been a rough period the last 2 years. Hopefully everybody's kind of survived as best you could. And I think we're all looking forward to a time when we start to get a few more safety positions that would make sense, right? And as long as interest rates aren't going up anymore, I think you could start to phase back into those. Now, potentially, you could do that. I'll probably wait a couple more months. I do a once annual audit of my performance and do any changes probably around January and then go for the next year. So we'll see. Maybe in January, I'll throw an asset class in that position. Like I said, what we're really doing, we've got this strategy is doing great. Nothing wrong with our short vol. It's doing great. This cash position, got to figure out something to put in there. And timing matters. Obviously, IYR 90% of the time works great, but you don't want to be in interest rate sensitive things when rates go from 0 to 5.5%. That's asking for trouble. So yeah, see the questions. Let's jump into this. What else did I want to do? Wheel of Fun trades. Does anybody want to see those? Sure. Why not? I'll answer my own question. Ask everybody, do you want to see it? And then just say, yes, you do. Wheel of Fun, everybody knows what this strategy is at this point. We've done several live streams about it. Seems like everybody loves it. A full course is coming, so be patient. But essentially, we're selling cash secured puts on the VXX or the UVXY. The reason we're doing that is because you can do this on anything. You could do it on any regular stock or anything. But the reason that selling put options on something like the VXX is such a good strategy is because it is directly mathematically inversely correlated to what probably the rest of your portfolio is. So anytime that you can add some negative correlation to your portfolio, you're going to be doing pretty well. So what we are doing is essentially selling put options, sometimes get assigned, sometimes not. When a get assignment of shares, turn around and sell the covered call, dump those shares as fast as we can. It's not about the capital growth of the actual VXX. Obviously, we don't want to be long VXX for very long. We're just trying to get as much premium as we possibly can, collecting premium twice, get out, get back into cash, and go again. So I've been basically sharing my results. And this year, I basically do this in two pieces. I have one aggressive layer where I sell quite close to the money. And then I have what I call the conservative layer where I'm really trying to not get assigned. So these are going to be, you can see over here for the aggressive layer, these premiums are significantly higher, right? But it does mean that you're going to get assigned shares quite often, right? You can see this one. For 3 months straight, I had shares, I was selling covered calls, and eventually took a loss. This strategy, you can see the premiums are quite low sometimes. The conservative one, the goal is to not get assigned the shares. And then at the end of the year, hopefully they both make, 5%, anything positive, because I'm doing this with basically an overlay. I'm not using any capital to do this. It's just free capital based on margin. Anything over 0 is positive return for me. But so far, this one's 4.65. I've got, I would say 6 weeks to go. Maybe I could bump that up a little bit. And then the aggressive one is at 12.66 so far this year. So both of them are doing what they are designed to do. These are not using any of my margin in my account. And I'm just trying to add a positive overlay to what I'm doing. So essentially right now, you can see the aggressive one. I was assigned some shares, so now I have to sell a covered call. I have to sell 12 covered calls in that one. And for this one, let me just double check because I remember, yes, exactly. I haven't looked at this in a few days. This one I'm going to be assigned, very likely. Let's check the market. Where is VX? 1856. So I'm probably going to be assigned shares in this one at 19. So what I'm going to do is for this one, I'm just going to sell another covered call. That's easy. Just choose the right strike. And for this one, I'm going to assume that this one is going to be assigned at 19, and I'm going to sell a covered call again here, 13. So I need 12 of these and 13 of these. And if something happens in the market in the next 2 hours and it spikes up and I don't get assigned, I will clean that up later. Don't worry. So I'm not going to put myself in any real trouble here. But what I would do, I like weekly cycles personally. So I would just go 7 days out. Let's do the 12 contracts for the aggressive strategy. The aggressive strategy, I don't mind dragging it out a little bit. So I'm actually going to do the 1950s. Okay, so this is basically out of the money, but it's aggressive. I don't mind holding this for pretty long period of time. I can do it for 2 or 3 months, just collecting premiums. And what is going on? Go to the trade tab. It's late. What is it? It's 2:45 in the morning for me, in case anybody's wondering. I live in Taiwan right now, so it is late. So I'm going to sell 12 of these, as I said, and let's try to get the mid price. Let's make this quick. Give me 20 cents. Wait. We got the 30-second rule. Typically, I would wait 30 seconds. I can see right now 19.50 to 20. It's probably not going to go. Let's see if we can get 19 cents. Move this window out of the way. Let's get this done. Okay. That one's done. So let's mark it in our performance log here. I can clean it up and make it look nice later, but I got 12 at 19 there. And then I need 13 contracts. This one is a little bit different because this is the conservative portion of my strategy. Remember, I do not want to get assigned, but when I do get assigned, I want to get rid of these shares. So in this case, certainly I would drop this one down to the 19 because I'm going to get assigned at 19, right? Right there, I'm going to get assigned these shares at 19. I could get about 29 cents, but something else you can consider is actually dumping it for the 18.50 or even the 18. If you didn't want to hold the shares, sometimes it is beneficial to go down a little bit. So you can see I might get 40, let's call it 42. I'm going to lose 8 cents on that trade. But it's better to kind of chase it down in the conservative one. So I'm actually going to do the 13 right here. So that would look 42, mid 42. The reason that I'm doing this, let's get it done first. This one is going to be 42 at 18.50. So you can see I'm going to lose 50 cents and I'm only making 42. So this is basically locking in a loss. But the reason is so that I can hopefully get back out and get back into selling short puts, right? That would be better. The conservative strategy is designed so that, look, it doesn't make money every year for me, or I think it actually has, but very little, right? Some years it's 2-3%, some years it's 10 or 15, but the conservative one, I do like to trade it completely differently, and I try to get rid of those shares as fast as I can. So for anybody who's been following the last, say, I don't know, 7 live streams, I've been doing those live trades in each one of them. That's what I do. So I can't, again, make any personal recommendations, but if you do divide your capital, when you're selling premium in this type of strategy, the thing that holds people back from making the good profit that I've been making all these years is people are actually afraid to take assignment of the shares. They're afraid to dip down in the money because they know the VXX, it's at 18.50 now. It could go to 15 to 12. It could go very low, right? And they don't have the confidence to understand that it's not going to go from 18.50 to 12 in 2 weeks. You're going to have several months of premium that you're bringing in. And don't be afraid to get your assigned shares at 19 and sell them at 12. You might think, well, I lost $7. Well, not really, because you're pulling in premium every single month. And as long as I bring in roughly the same premium, or hopefully even a little bit more, who cares? I got assigned at 12 or 19. They got out at 12. All I have to do is make $7 in premium. And if you're doing it fairly aggressively, you can handle that in several months. So that's what I would say, is that you might want to try both of them side by side with small amounts of capital in both, right? Don't jump into the deep end with this. But you might actually feel that the aggressive strategy suits you better. You might also feel like it just feels too punishing for you to watch your shares go down. And so you want to be the conservative side, to where you're trying to never get assigned your shares, picking up 5 cents, 10 cents. It's free money to me because, again, it's an overlay. I don't know. I don't know what your style will be. I do both of them side by side. And yeah, there you go. Pretty easy stuff. So now let's see if I can get through some of these questions. That took a while, but hopefully everybody learned a little bit. Most of my live streams, we don't talk for 50 minutes on the segments. Usually I try to keep it to about 30 minutes, and then we do the questions, but let's get into it. So all sound is good. Thank you very much. Hopefully it's all good. I didn't even check my levels. Sometimes I don't do a live stream for a month. I kind of forget how to do this. Looks good, looks good. How was Japan? Japan's always good. I was just in Japan for a week. I love it. It's probably the 7th time I've been there. What a great country. I love Japan so much. Okay, real questions. We drank a lot, by the way. If you look at, I don't know if you follow my wife on Instagram, but if you followed her account, she uploaded about 12, posts over a 7-day period. Our whole trip's basically documented there. So, all right, questions. Which of your vol dashboard metrics is most significant for your tactical volatility strategy? So, without giving away too much of the secret sauce here, certainly the where's my dashboard? Okay, so each strategy, scrolling sometimes makes people dizzy. Sorry about that. Each strategy uses a different set of metrics, right? It's not diversification if all three of them are using the same metrics, right? So each one of them is geared to focus on different things. What I would say, I don't want to tell you exactly, but what I would say is tactical volatility is most directly focused on the VIX futures. So anytime you see something like the VX30 to VIX roll yield, you see the cash VIX oscillator is a secondary, but VIX futures directly, because they are volatility ETPs, of course, the VX30 to VIX roll yield is essentially the methodology of the products. So that's actually going to be ranked, I would say, the highest among that strategy. It's using 3 or 4, but that one would be the one that's probably giving the most boost to the robustness of the signals. Some of the others would be the VIX to VIX 3M medium crossover. I always like this one. Again, it's one of those things I can't tell you, okay, this one's best, this one's second best, because everybody's personality when they're trading is a little different. That's why we have a fast, medium, and slow crossover. If you like a lot of action and a lot of change of direction, then the VIX 9D might be more your speed. Some people, they don't want to be completely buy and hold, but they really want to reduce that trade frequency. You could go out to the VIX 6M, right, the 6-month. But for me, I think that the 3M is sort of for my personality, so that one would be included as well. Adjusted M1, M2, always important for every strategy. This is basically just levels of contango, but adjusted for the days to expiration, which is obviously super important because with 1 day to expiration or 15 days to expiration, the VIX futures mean a completely different thing. It's totally meaningless to look at a level of contango, right? That doesn't mean anything because days to expiration factors very heavily in that. So, all right. So I think this is when I asked, what is your favorite? Cash, nothing wrong with cash now, right? I don't think you would have said cash from 2012 to 2020. But yeah, absolutely right now, it's pretty difficult to make a case against, like I said, just dumping extra money in the SVH or something like that. The SGov, I think it is. Something like that. There's many of them. Those, every company, they're all going to have their version of it. The Vanguards, the SPYs, whatever, they're all going to have their version. All right. All good, all good, all good. Long waited. Sorry about that. I wish you could see this room. It looks like I'm in a padded room, like I'm some kind of, mental patient from the past. But I had to wait to get the soundproofing because it was just super echo room. Okay. Why is that so small? What happened there? How about that? What's the indication you mentioned about VOLI? What's the indication you mentioned about VOLI? It seems you believe VOLI has some ability to predict a market pullback. No. What specific parts of the VOLI data should we be looking at to figure this out? I don't know what that means. No, the VOLI is very similar to the VIX. So the VIX index is basically just a statistic. It's derived from S&P 500 options, whole set of options, all strikes. The way that the VOLI is different is it's also a very similar index to the VIX, except it uses the SPY, not the SPX, and it uses at-the-money options only. So when you're looking at the VOLI, you're looking at the money SPY options, and the VIX is a strip of all option strikes on the SPX. So essentially, one of them at the money, one of them all strikes. What happens if you just subtract them, right? The VIX minus VOLI, for members of VTS, they can get the full articles and whatnot. But let me see if I said anything interesting here, because it actually quite predictive on certain things. I don't know if you mean this article that I read, but the way that I use the VOLI more specifically is with options trading. So like I said, maybe I can just explain it with this. If you've got the VIX index, which is a strip of all options, you've got the VOLI, which is at the money SPY. When you subtract them from each other, it's essentially measuring the residual is all the out of the money options activity. So if you've got a situation where the VIX minus VOLI ratios or the residual is quite high, that's going to mean that the out of the money options are actually priced pretty high, right? So if you are choosing between, say, anything really, a butterfly option, which is 2 strikes in the middle, or an iron condor, which is 2 further out strikes. If you've got a VIX minus VOLI ratio that is high, you might want to actually focus where that premium is going and do the iron condor for that period. If there's residuals very low, well, that means that the at the money VOLI options are actually pretty juiced, and you might want to do the butterfly. Same thing with a straddle or a strangle, right? They're basically the same risk profile. It's just strangle is selling out of the money options and the straddle is selling at the money options. So you can use it to just get that little bit of an edge for yourself. And that's what trading always is. It's just about building small edges. You're never going to get something, regardless of what everybody on Twitter, all these traders will tell you, this indicator, it's going to change your life. Nothing works that way in the market. All you can ever do is just get small edges here and there, right? If you manage your trade fees, it's a little bit of an edge. If you understand position sizing, you're a little bit better off. If you got a little bit better mental game and you can manage your emotions in a drawdown, it's a little bit of an edge. If you understand, when I'm selling options, I want to try to choose the strikes that are paying me slightly more efficient premiums. If you do all of these things and you add up 7 or 8 edges, well, now it's life-changing. But no single edge is ever going to just radically change your investing future. It just doesn't work that way. So I don't know if I actually gave you the indication that VOLI is just this magical thing, but no, it's just one small edge, and that's one way that you can use it. You can, the nations indexes also have things like SDEX and TDEX. You can go as deep as you want with this stuff, but also if you're in the Thinkorswim platform, you can go into the profile and you can actually look at the premiums of all the strikes. And you would think that it's just this smile, right? Just this nice, consistent smile. But in the moment when you're exercising your trades, there might be little kinks on those lines. So if you zoom in on where the pricing is actually happening, you might realize that there's a little bit of a kink. And if that's the case, let's say you're doing an iron condor and the 450 strike for that period where you're looking at it, it's high and the 455 is much lower in relation, well then sell the 450 and buy the 455. It's not going to change the trade, but it's just that little bit of an edge, few pennies here and there. So that's what I would say the VIX minus VOLI is useful, is getting an idea of where that premium is actually being traded. Now, if you were to choose between the two, I would say the VOLI is a better index. The VIX is the branded one. Gets all the clicks and the eyeballs. But what are traders really interested in? Most of the time, we're interested in at-the-money options. So the VOLI is just structurally better, but it just doesn't have the brand. It doesn't have the longevity. It doesn't have millions of articles and videos about it. But yeah, if you were to choose between the two, probably VOLI is better. Okay, interesting question. I can cover this pretty quick. Why VGLT for super low volatility in the defensive rotation strategy? I hope I have your exact answer all ready to go here in this spreadsheet. The essential reason is, didn't do screen share. I almost screwed that up. The reason, hopefully people don't study this too much. This is the actual strategy, but because the VGLT during super low volatility periods, so what this person is asking is why in the defensive rotation would we cycle out of the NASDAQ and into the bonds during super low volatility? Why would we do that? Why not just hold stocks during that period? Well, the reason is because stocks don't do nearly as well. So I actually have it here, but for some reason my scale is messed up. This might beach ball my spreadsheet. So Okay, it didn't. But the drawdown is hit and miss. There's big periods of underperformance if you do that. And essentially what's happening in this moment, you can imagine this is during extremely low volatility. This is only happening, not very often. 15% of the time, this is when this is happening. So when volatility gets that low, the markets, you could say, are probably running on fumes, unless it's a year like, say, 2017, where it was just low vol, everything perfect for a super long historical period of time. But most of the time when volatility dips to those extremely low levels, pretty much the market's done. And at that point, it's just chop. And so the point of moving to something like bonds, even gold during low vol works extremely well as well. You're essentially trying to reduce all that chop. Why suffer a 20 to 25% potential drawdown when you're not really going to get much progress out of that? Again, you might get a 2017 where you kind of kick yourself for a few months thinking, I probably should be in that. But we're long-term traders, and the vast majority of the time, it's just not worth it. And it's also a function of diversification, because we can't hold stocks all the time. You can see our safety positions of utilities, gold, and when interest rates start dropping, real estate, all different, right? I don't know which of those three is going to be the best one, so I'm going to dedicate one position to each of our three strategies. This one's already going to be in stocks during low vol. We're already going to be in short volatility during low vol. So why not have one of the strategies just diversification-wise kind of kick out there? And you can see performance-wise, I still have it on screen share. Let's hope. It's getting late for me. Sorry about that. But yeah, you can see that it can be punishing, and there's no reason. We're only eking out, in this case, 2.65% return. Not terrible for only 15% of trading days, but I just personally don't think it's worth the whipsaw that you're getting at that levels. Now, again, as a VTS member, the reason that I go into such detail about all of these ETFs and I basically show the strategies and here's what would happen if you held this one and that one, it's because I know what I'm doing and I know what matches my personality. But if you ever do see something that you think, wow, that one actually, I get his point, but I actually might want to stay in this one, right? Replacements are okay. As long as the strategy itself is still intact, as long as the reason why we're doing it. You have to remember that the whole premise under my investing is that there's nothing wrong with the stock market about 60% of the time. Absolutely nothing wrong with just buy and hold the stock market during 60% of the lowest volatility readings. You're good to go. Nobody's going to argue against that rate of return. What we're trying to do is avoid all the disaster that comes with buy and hold if you don't cycle out into safety. You are guaranteed to suffer those excruciating drawdowns. So my entire portfolio is based on that concept. I don't think anybody out there is under the impression that they have to do better than the stock market when it's doing well. It's actually really hard to beat the stock market when it's doing well. That's not what this is about. What we're trying to do is improve our performance, not by leveraging up the good times, but by minimizing the bad times. That is so much more efficient. And to be honest, if you really focus on it, it's easier. It's actually very difficult to beat stocks when stocks are doing well. It's not difficult at all to beat the stock market when stocks are crashing. So that's the focus of our portfolio. And if you ever see a replacement that makes sense to you, feel free to email me and we can have a back and forth. I do Zoom calls with people if they need to chat, and we can get you into what you're most comfortable with. But yeah, that's why I do these live streams, and I give so much detail about the strategies themselves. HSA ETFs work quite well recently because the short end is so much higher. Yeah, the recent part is the trick, right? Because I don't know. I mean, I guess you could say that we saw this coming the whole time. Like it was basically telegraphed for a while. So I suppose we could have done that. But yeah, you never know when it's going to end. You never know when they're going to reverse course. TLT had a fantastic couple weeks there. You never know when it's going to happen. I like to just look at a big, long chunk of data and say, we're not going to hit everyone, right? I had a basically impeccable track record until 2022 interest rates. And then for that 6-month period, I didn't do any better than the stock market. So kind of, it is what it is. We don't bat 1,000 around here, but pretty good. Okay, I answered that for you. There's that question again. For some reason, there is a percentage of the population that just is wired to want to short the stock market. And for me personally, I don't understand it, but that's probably because I've seen all the data and how tremendously difficult it is to make money if you're shorting the stock market. But yeah, it's just by far the most common question. Every time you cycle out of stocks, I'm going to get 10 emails. Well, I mean, now that we're in gold, why don't we just short the stock market, right? I'm not hacking on you, by the way. That's a totally legit question. Good to know about the inverse. Yeah, there you go. Answered it for you. Good answer. I asked you, what do you think's going to happen if you buy all the low beta names and you short all the high beta names? Uh-oh, that's not good. It'll work this is something that I would say, I don't know anything about BTAL. This is just a totally off the cuff comment. I could be completely wrong, but it strikes me as something that sort of an old seasoned veteran would think up, right? Because certainly there was a time in the market in years past where something structured that way would have made a lot of sense and it would have probably done much better. But the way that the markets work now, and I think people are really catching on to this, is that sometimes the high beta names, for whatever reason, if you could put your finger on why this is happening, you could be a multimillionaire. But sometimes it is the names that you would not expect are actually the ones that you would want to hold. It just turns out that way. And certainly shorting them, what a disaster, So, do tactical strategies capture the total return with dividends? Yes, if you're holding it, absolutely. Everything that I ever show includes dividends, always. But because you're tactical and you're moving in and out, you only get the dividend if you're holding it on that ex-dividend date. There are times when we cycle out. So this is actually an interesting little side tangent I can say, is I would never prioritize dividends, right? Some of the ETFs that we hold do have dividends. But let's say this strategy, for example, I was going to exit out into cash on whatever date. And I also knew that that's the date of the ex-dividend. So if I just hang on one extra day, I'm going to get the dividend. What would I do? Would I actually delay the signal just to get my dividend? The answer is no. I would never do that. I always default to the strategy positions no matter what. I don't even look at the dividends. It's just, yes, you are getting them in several of these positions. Yes, they do give you the dividends. So check your broker, make sure you've signed all your W-8 Ben forms and all your, non-withholding if you're a foreigner, all that stuff. Make sure you're up to date because you will be getting dividends. What's your Twitter handle? @VolatilityVix. Let me see if I can pull up my Twitter right here. Follow me on Twitter. Does it say? There it is. Oh, I didn't do screen share. There it is. So right here, @VolatilityVix. You can all follow me. I wouldn't say I'm actually not. I've tweeted 9,296 times, which is incredibly low. I've seen people in my, in my space, the finance space, 100,000 tweets, more than that. Some people love Twitter. For me, I do like making videos. It's just, oops. Hopefully that doesn't play. Yeah, I just like YouTube a whole lot better. By the way, quick reminder, I did do a YouTube video that I would like everybody to watch, and I want to kind of highlight this. I don't do this on every live stream, but I do want everybody to watch the Dave Ramsey video because not only is it kind of fun to hack on somebody who's, just painfully wrong on so many things, but this was one of those videos that doesn't come up often, but I actually got to touch on many, many different investing concepts, from arithmetic geometric return differences, which are, our friend Dave Ramsey doesn't know what that means. Sequence of risk returns, huge. I'll probably do another follow-up video explaining what all of that is. But, of course, Dave Ramsey went off on a real rant on everybody. But in the end, I guess the egg's on his face because he didn't know what he was talking about. But there's a lot of concepts here. So go ahead and do that. And how many people are left here? 41 people. I suck at YouTube. I'm too old for YouTube. I'm, almost 50 years old. This is not my game. I didn't even have a cell phone till I was nearly graduated university. So for me to learn all this stuff, I don't know any of it. But let me show you two things, and you can just vote in the comment section really quick. So I'm going to show you, what is this? I'm going to show you two thumbnails. Okay, this is the thumbnail that I used for my video, okay? And then what I did is I kind of want to get help doing thumbnails. So keep this one in your head. And then I actually paid somebody on a website called Fiverr to design one for myself. So you ready? Everybody's going to vote which one's better. This is the one that he designed. Which one of these is better? The one that I made or the one that this guy made? I don't know. You let me know. His or mine. His cost about $70. So you can let me know which one of those is better. I don't know. I'm terrible at YouTube. It's one of those things where I do feel like content-wise, it's fine, but for some reason my videos don't get views. I'm not overly complaining. I appreciate the people that do follow me, but there's got to be something I'm missing. People just aren't clicking, right? It's obviously my titles and thumbnails are terrible, so nobody clicks on it. My retention rate, once people get to the video, those numbers are all good. People typically stay, they engage, I just can't get people to click the video. So help me out. Is his thumbnail really any better than mine? He's a 22-year-old kid. Is this what I need to do? All these colors and, I don't know. What do you think? How's this one? I don't know. I got to figure out this YouTube thing at some point. Okay, trend following. There's only a couple left and then I can go to sleep. It's 10 after 3 in the morning. Trend following for me is to avoid tail risk. Agreed? If I happen to beat the benchmark, then more the better. Yeah, I would agree with that. It just depends on personality-wise. Perhaps for you, you like to stretch those exits to safety a little longer than I do. It's totally up to you. Again, general premise. For some reason, and if you think about it, who you follow on Twitter, the YouTube people you follow, 95% of the investment world is focused on getting better performance by improving performance in good times. That's what all of these people are talking about. All these trading services, talking about buying long calls, all these things, like everything we see is about boosting performance in good times. There is almost nobody out there that is focusing on reducing disaster during bad times. That's where the edge comes. That's where the biggest edge comes. If the stock market's doing extremely well, yeah, maybe you can, like we use leverage. We use short volatility ETFs. Of course, they do better than the stocks, so we do as well. Tactical vol is, 30%, 40% a year. We do 2 times NASDAQ. Obviously, that's better than the SPY. But the real edge comes from what you're going to do in that 30 to 40% of ambiguous periods. For some reason, very few people focus on that. Okay. I've got one, mine is better. I like his better. His better. His looked a little better. I like yours better, but I can see how his over the saturated colors and larger. Yeah. Damn it. This kid beat me, didn't he? Is this worth $70? I don't know. Because what I want to do is essentially, I just want to find a video editor and a full-time, basically YouTube help. Just some 25-year-old, 30-year-old kid who does all my thumbnails, does all my video editing. And if that was the case, I could put out 3 videos a week. But that video, the Dave Ramsey takedown where I tried to use like the young kid, he owned this guy. I tried to say eviscerated. I eviscerated Dave Ramsey video. That took me 10 hours to edit that video. If I could outsource that, I could crank out a whole lot more content. So, okay, I think we're done here. So give the video a like on your way out, and I'm going to start doing regular stuff. I've now got the sound panels. We're good to go. Hopefully the sound is good, which means we can get into weekly live streams again. If you've got more questions for next week, come a little earlier and ask them, because oftentimes there's more questions than we have time for. I've done 2 to 3 hour live streams many, many times, as you know. So try to avoid that. Oh, somebody just gave me a thumbs down. That's okay. As I always say, thumbs up, thumbs down is the equal on YouTube. It's counted as engagement. So if everybody wants to give me a thumbs down on your way out the door, that is fine too. Just engage in some way. Thanks, everybody. See you next time.